hedge accounting is voluntary. So it is not mandatory to be applied under IFRS 9. If the management intends to apply, they can apply hedge accounting, which means that if there is a hedging relationship between a hedged item and a hedging instrument, and if that relationship can be proved, and if they wish to opt for hedge accounting, means opting for hedge accounting means they want to set off the gain on the hedge instrument with the loss on the hedged item, vice versa. So the intention is to minimize the exposure to risk. Hedging relationship means that there is an inverse relationship between a hedged item and a hedging instrument, that if there is a gain on one, there is bound to be a loss on another. If this is not the case, then it is not a hedging relationship. And a hedging relationship means a gain on one item will result in, or will have an inverse relationship with the hedging instrument. So the gain on one sets off with the loss on another. So the risk of the entity gets minimized, or in rare circumstances can be reduced to zero if there is a perfect hedging relationship, but otherwise the risk is minimized. Because if we do not have hedge accounting in place, or hedging, we have not entered into hedging relationships or have got into futures or forwards wherein we are able to minimize the exposure of risk, we will not be in a position to save the fair value of the items we are holding onto the balance sheet, or the cash flow variations which we may encounter. So what we need to protect? We wish to protect the fair value of the item, so we have a fair value hedge. If we wish to protect the exposure to currency risk, we have cash flow hedge to deal with it. And third is, if we have a foreign operation, then any net investment in a foreign operation is protected for foreign currency exposure. So cash flow hedge and net investment in a foreign operation are dealt with in the same manner. Fair value hedge is treated differently. Any difference in fair value hedge is treated directly in fair value through P&L. As the name suggests, fair value hedge, any difference, any change is directly treated in fair value through P&L. For cash flow hedge and net investment in a foreign operation, the effective portion of gain or loss is shown as part of OCI. The ineffective portion of gain or loss is shown as part of profit or loss account. So if you remember the components of OCI, there was a cash flow hedge component under items which can be reclassified to P&L and cash flow hedge reserve. Only the effective portion of cash flow hedge reserve is shown as part of OCI. Ineffective portion, in a layman's language, we can say that if the management intended to get into a hedging relationship, they were not successful in identifying the hedging instrument which could exactly set off the gain or loss on the hedged item. So they were ineffective in choosing a hedging instrument. So if the effective portion is something which is the quality of that hedging instrument, that it was supposed to do this. This was expected performance from that hedging instrument, that it is going to set off the gain or loss. So the expected performance of that hedging instrument is shown as part of OCI. Anything unexpected happens will be considered as ineffective portion of gain or loss is shown as part of profit or loss. Earlier, there used to be 80 to 125 relationship. Earlier, under IAS 39, there used to be 80% to 125% relationship. That if the variability is in the range of 80 to 125, it was considered a good hedging instrument. What it meant, that if gain on one side is 2500 and loss on another side is 2000, if we compare this is in the range of 80 to 125. If the difference was beyond it, loss is 1800. So this is below 80 and on the upper side it is above 125. So anything beyond 80 and 125 in a relationship was considered ineffective portion, which was breaching this relationship. Now this relationship is no more applicable today. Today it is a simpler way of recognizing that the objective of hedging relationship is to minimize the exposure of risk. So if the hedging instrument is able to set off the gain or loss up to the value of hedged item, it is considered effective. Beyond it is considered ineffective. For example, there is a gain on forward contract. The entity entered into a forward contract to minimize the exposure to risk. The gain on forward contract is equivalent to 8,38,7096. 83,87,096. And on the other side, increase in the value of asset, which is the hedged item, is equivalent to 8620,690. So if the hedging instrument is able to set off loss up to the value of the hedged item, which is the hedged item among them? This is hedged item. This is instrument. How much is effective and how much is ineffective? How much is the effective portion in this effective portion? And how much is ineffective? How much is the effective portion in the gain on forward contract? And how much is ineffective? And what if the gain is gain on forward contract is equal to 11612,904, and increase in value of asset is equal to 10 lakh. $10 million. In both the cases, how much is effective portion in this case and how much is effective portion in the second case? Please tell. If you go by the words that up to the value of hedged item, set of the gain or loss up to the value of hedged item, it is considered effective. Up to the value of hedged item, it is considered effective. Anything beyond it is considered ineffective. So how much is the effective portion in example 1, in situation 1, which will be shown as part of OCI? To be shown as part of OCI, how much? In this case, there is one effective portion, there is ineffective portion to be shown as part of P&L. How much is effective? How much is ineffective?
In this case, when the increase in the value of asset is greater than the gain on the forward contract, so it is all effective.
So this amount is all effective to be recognized as part of OCI.
Yes, and the second one, it is 1,61,000 or 16,12,904.
This will be effective, and the difference between the two will be considered ineffective. Any excess is recognized immediately in P&L. So the effective portion is 10 million, and ineffective portion is 16,12,904. Agree? So this is how cash flow hedge is different from fair value hedge. In fair value hedge, the entire difference will be considered as part of P&L, but in case of cash flow hedge and net investment in the foreign operation, we need to bifurcate it into two parts. Up to the value hedging instrument is able to set off the gain or loss, up to the value of hedged item will be considered effective. Any excess will be considered as ineffective. In absolute amounts, not considering, not being emotional whether it is gain or loss, in absolute amounts, because definitely they are inversely proportional to each other. One will be gain, one will be loss. So this increase in value of asset is, we are intending to purchase an asset in future. And if the value of that purchase an asset in future, if we're intending to purchase an asset in future, and if we are trying to hedge the exposure to risk, the cost of the asset for the firm is increasing. That's what it means. Increase in value of asset. We're intending to purchase an asset in future. So the cost to the firm is increasing. If the cost to the firm is increasing, that is a loss to the firm indirectly. But we entered into a forward contract which has resulted in some gain on the other side. So up to the value of hedged item, if it is able to cover up that loss, So if it can cover up loss till 8620690, it is an effective instrument. Beyond it, ineffective portion. Now, ineffective gain or loss, whether gain or loss, without being emotional, we'll be showing it as part of P&L.
Amit, just one thing. In this, say for first example, this 86 lakh 20,690 is this the indexed exposure on the underlying asset, or it is the hedged item?
This is the difference in the fair value of the forward contract at the beginning and on remeasurement fair value at the end. The difference is the gain on forward contract. We'll do the question later into it. We can directly jump on to doing this question later into it. Have a look here. So there's an example in your book. Let's do it directly. Then I'll come to fair value hedge. Because when I'm trying to explain the difference between fair value hedge and cash flow hedge, I'll have to talk about the effective portion and ineffective portion. So let's do the example relating to it. Please have a look at it in the book.
Amit, one question before the example.
Yes.
On the first scenario, the difference between 83 and 86, is that a loss which will be going to P&L?
This is loss and this is gain. Gain, loss. So this entire amount will be going to OCI 8387096. This entire amount will be going to OCI and this portion will be going to P&L.
Perfect. In the second example, we have actually gained 161 because of increase because of the forward contract. We are taking it to P&L. But in the first case scenario, we are paying extra a difference between 83 and 86. So
You're right.
is that a loss, the difference between the two, which will be charging to P&L, or there will be nothing charged to P&L?
In this case, up to this amount will be charged to OCI. This portion will be charged to P&L. 161290 will be charged to P&L.
This is perfect. On the first case scenario, I'm happy with the effective portion to be charged on the OCI, which is 8387096. I am just checking the difference between 838 and 862. Will that be charged to P&L as a
No. That is simply for comparison.
Okay.
That is for comparison only. This is unrecognized. We do not recognize it because when we'll recognize it, when we'll settle it finally. Till then, we are comparing the movement of the forward contract with the movement of the value of the asset. Because what does hedging relationship means that we can set it off against each other when we finally settle it. That's what hedging means. If this forward contract was treated separately, it would have been dealt with under IFRS 9. If you have taken a forward contract and if you do not wish to get into hedging, you do not opt for hedge accounting, then that forward contract is treated in its own individuality, no relationship. But now when we enter into a hedge accounting, we try to compare with the hedged item, that the movement in hedging instrument, we compare with the hedged item. And when we compare with the hedged item, up to the value of hedged item, we can recognize.
Okay.
OCI, beyond it, we recognize as part of P&L.
Got it.
Forward contract is going to set off any gain or loss in future. So when we finally purchase that asset, at what cost that asset comes into the firm, there will be loss on it because we are buying it at a higher cost in future because of the increase in value of that asset in the market. We'll be buying it at a higher cost. How that higher cost will be settled? That will be settled through the gain earned on this forward contract. Okay.
Got it.
So it will be more clear. Let's do this example. I've taken the same figures as given in the example because I knew I'll be discussing this with you. So I've taken the same figures purposely so that this Pets company signs a contract on 1st November 2001 to purchase an asset on 1st November 2002. After 1 year, they plan to purchase an asset for euro 60 million. Bets report in US dollars. Now they plan to purchase something. Bets company enters into a forward contract. Forward contract to buy euro 60 million. And they enter into this contract to buy on 1st November 2002, that they'll buy this asset in 1st November 2002. So they enter into a forward contract to buy euro 60 million because they sign a contract. They have signed a contract for euro 60 million. For it, they'll need this money on 1st November 2002. They've entered into a contract to buy this. Now they've entered into this contract to buy euro at a rate of US dollar is equal to euro 1.5. So how many US? One 1.5 times euro. If euro is 1.5 times, dollar will be lesser. So how many US dollars? 60 million. So if I take in terms of thousands, 60,000 divided by 1.5, 60,000 divided by 1.5. $40,000 need to buy in future. 40,000 US dollars. If they would have purchased it outrightly, what would have been the cost? If on the day of entering contract, the entity would have purchased the asset, they would have got it at for what amount? On this date, 1 US dollar is equal to euro 1.45. So they're spending similar amount, 60,000 euro divided by 1.45. They would have been successful in purchasing it for 41,379. So since they have entered into this contract for $40,000, the requirement of IFRS 9 financial instruments or the requirement of IAS 1 presentation of financial statements is that you are required to report your position on the reporting date. The reporting date in this case is 31st December. The reporting date is 31st December 2001. So if the reporting date is 31st December 2001, and if you have entered into a forward contract, you need to remeasure that forward contract at the end of this year. The forward contract need to be remeasured. And if you remeasure this forward contract, what is the value of this on 31st December 2001? The value of this forward contract turns out to be $1 on this date. If the same contract is purchased in future, the value of the contract on 31st December 2001 is equal to €1 is equal to $1 is equal to 1.24 euro, which means that 60,000 divided by 1.24 equals to 60,000 divided by 1.24, 48387 US dollars. That if they have to buy 60 million euros, how many dollars they'll have to? If they would have entered into this contract on 31st December, they would have to pay 48,387. But now they have entered into a contract wherein they entered on 1st November 2001, wherein they'll have to pay only 40,000. Is there any gain or loss? Have they gained in terms of the contract? How much is the gain on forward contract? Gain on forward contract. 48387 minus 40,000. The value of the contract has increased from 40,000 US dollar to 48,387 US dollars. So there is a gain of 8,387 US dollars. They will have to pay only 40,000, but the value of the similar contract in the market now is worth equivalent to 48,387. If someone buys or enters into a contract now, they'll have to pay 48,000. Since they entered early, how much is the gain? Now we need to compare this. We need to compare it for the purpose of hedge accounting. For hedge accounting, we need to compare it with the change in value of asset, because we plan to set it off against the gain or loss in the increase in the value of asset. Now for the purpose of comparison, if they would have purchased the asset outrightly on the date of entering into this contract, how much money they would have paid? They would have paid 41,379. What would have been the position on 31st December of the increase in value of the asset? $1 on 31st December is equivalent to euro 1.20. This is the position on 1st November 2001. This is the position on 31st December 2001. That if they purchased it on 31st December, what would have been the value? The value would have been 60,000 divided by 1.20. The asset would have costed them 9,000 more. So increase in cost of the asset will be set off with the gain on the forward contract. Increase in cost of the asset. How much is the increase in cost of the asset? Increase in cost of asset is 50,000 minus 41379. 86. If I round it, it becomes 8621. Now, how much amount I can recognize in P&L and how much amount I can recognize as a financial asset. So this is the accounting we'll be doing. We'll be recognizing a financial asset in the books, but the fight is how much will be, what will be on the credit side, whether OCI or P&L. In this case, up to the value of hedged item, like up to the value of hedged item, that is till 8621. Till 8621, it will be forming part of OCI equity. Anything beyond would have formed part of P&L. So when we compared it, we got to know that the increase in cost of the asset is higher than the gain on forward contract. How much higher? It is higher by approximately 3000. So the entry which will be passing at the end of the year for hedge accounting will record a financial asset. We have been successful in getting a financial asset. This forward contract is resulting in a financial asset, and the financial asset gain is equivalent to 8387. Up to this value, we can recognize the gain as part of OCI, which is a component of equity. 8387. This is the accounting we'll do at the end of the year. Now we are actually settling it on 1st November 2002. So what will be the position on 1st November 2002 on the day of settlement? That is 1st November 2002. We again need to remeasure it. We'll try to see the gain or loss on the forward contract. So we'll compare the gain or loss on the forward contract in similar fashion like we did here. And then we'll compare it with the gain or loss on the forward contract. So what was the value now on 31st December will be compared with 1st November 2012. Value on 31st December December 2001 will be compared with first November 2002. So the position on 31st December was forward contract, it is 1.244837. 1.24 is equal to 60,000 divided by 1.24 as calculated earlier. The value on 1st November 2002 of the forward contract is equal to 1. US dollar 1 is equal to euro 1. It turns out to be equal to euro 60,000. The gain on the forward contract now is equal to 11,613. Now from December, we have already recognized in the financial position until December, we had recognized a financial asset. This we have already done. This is the position of our financial asset. Already recognized in equity. The figures are restated on 31st December 2001. Hedge accounting, the change in the value of asset. If we compare for the change in the value of asset from 31st December to now, value of asset is equal to 31st December, the value was 50,000. 1st November 2002, $1 is equal to 1 and value turns out to be 60,000. So increase in cost of the asset. The cost of the asset has increased from 50,000 to 60,000. If they would have purchased it today, they would have to pay $60,000, but they have entered into a contract to buy 60 million euros by paying only $40,000. But on the other side, there's an increase in the cost of asset, which they try to minimize the risk of exposure in buying this asset. That what if the cost of the asset increases? The cost of the asset increases by 10,000. So up to the value of the hedged item, that is up to 10,000, it is effective portion, and anything beyond it. So the total gain now between the date of balance sheet 31st December and the date of settlement is there is a gain of 11,613. So up to the value of hedged item it will be, so the entry will be financial asset, the same entry, financial asset, but now we have financial asset is debited by 11,613, out of which up to the value of hedged item 10,000 will go to OCI, the difference market, debit the cash, debit the asset with the amount of $60,000. That's what we have to pay today, and we have amount of $60,000 of, because our forward contract has reached that position that 60 million euros we are supposed to buy are equivalent to $60,000. 60 million euro are equivalent to $60,000. So we have cash to pay for purchase of this asset. Credit $60,000. We have been successful. Now we need to set off this contract. The contract has a value of 11,613 debited now, and earlier we debited an amount of 8,387. The total amount in the contract asset is 20,000. On settlement, we'll receive in the form of cash. This is how we got this cash account debit. $20,000 on settlement of this financial asset, which we had recorded. $20,000. If we would have purchased it outrightly, we could have purchased it for 40,000. We entered into a contract that we'll be paying only $40,000 for getting 60 million euros. We got the difference of 20,000 from settlement of this forward contract. We received this cash of 20,000 and we were able to purchase this asset. How much is the gain recognized in OCI till now? OCI will be removed from equity and will be included in the initial cost of the asset. How much is it? How much is the balance in OCI? $8,387 plus 10,000. So it has not been completely successful. Perfect hedge. So this will reduce the cost of the asset. So this is how we'll deal with the cash flow hedge. Any questions on it?
In this question, what if in December 2001 and November 2002, euro is
We entered into a contract on 1st November 2001.
yeah.
If the reporting period falls in the middle, if we have to prepare a balance sheet in the middle, we need to remeasure our balances on 31st December as well.
Perfect. But my question is this: what if on 31st December 2001 and November 2002, euro rate is 2 instead of declining, it is increased. I mean, will be in a benefit in that case. The value of the asset will be less than 40,000. So, will there be the same entries?
See, we have to make payment in euro,
Yeah,
and our currency is dollars.
perfect.
Our currency is dollar. We have to make payment in euro. We have decided that we'll pay only $40,000.
Yes.
Okay. But by the end of the year, got to know that the value of that asset has increased by 8621. Means we'll have to pay more number of dollars.
But my question is, what if the value of the asset is decreased instead of increased? In this case, the value has increased.
Value of the asset is increased for us, that we'll have to pay more to buy the same asset.
Amit, my question is this: what if the euro rate is more instead of 1.20 on December 2001?
Okay, you're reversing the question. Sorry.
Yes. My question is this: if the euro rate is 2 on 31st December 2001, what will be the impact then? In both the cases,
Impact will be, there has to be hedging relationship. Means that if I am going to suffer a loss on this contract, there will be gain on purchase of asset, that the asset will be available to me at less than $40,000.
exactly.
Okay. So if I try to change the figures in a hedging relationship, I'll have to ensure that there will be gain on one side, there will be loss on one side, because if it doesn't meet this criteria, it is not a hedge accounting, and we have dealt with the hedging instrument, which is nowhere closer to being a hedging instrument. Okay. So for selection of a hedging instrument, we have to ensure that whatever hedged item we wish to protect or minimize the exposure of risk, there has to be a hedging instrument which has an inverse relationship with this. If there is no inverse relationship, it is not considered a hedging relationship. There has to be a relationship. Okay. Fine.
Okay.
So if we change the figures, we'll have to change the language of the question to show the fall in value of an asset for us. Okay. Actually, we Indians are mathematicians, and we are very logical in our approach, which is one way beneficial for us as well. Shall I move from cash flow hedge to fair value hedge? Now, fair value hedge is simple, that if there is any difference, where we can take it directly to P&L. Any difference we can directly to P&L, because it is FVTPL criteria direct. FVTPL, we do not have to bifurcate it into what goes to OCI, how much is effective and how much is ineffective. Life is simple in case of a fair value hedge. Now, what we try to fair value hedge? Fair value hedge is we try to protect the value of inventories, protect the value of a gold. So we are trying to protect the fair value of an item. In case of a cash flow hedge, we are trying to protect the currency risk. Is the reason there is a movement in cash flow hedge. Here we are trying to protect the fair value of an item. So here's an example leading to fair value hedge as well. On 1st July, Jones acquired 10,000 ounces of a material which it held in its inventory. The cost is 200 per ounce. The total cost of inventory with them is 2 million. On 1st July 2006, Jones acquired 10,000 ounces. Cost is $200 per ounce. Total cost $2 million. So I'm taking it $2,000, rounding to 1,000. Jones was concerned that price of this inventory would fall. Now, when we have an expectation and when we, on the basis of our past experience, we are able to judge that this is going to fall, then only there is a concern that we wish to protect it. So Jones enters into a futures contract. The difference between futures and forward is futures is a regulated market, forward is not a regulated market. That's the only difference, otherwise the instruments are same. On 1st July 2006, enters into a futures market to sell 10,000 ounce at a price of 210. 10,000 ounces sold at a price of $210 for delivery on 30th June. Will he actually deliver this inventory, or he's simply trying to protect the fair value of this inventory? What do you think? When we enter into futures or forward contract, do we give actual delivery, or we simply settle on net position, resulting in a financial asset or financial liability? Or we actually deliver the inventory or deliver the gold which we are trying to protect? What do you say? We can enter into futures or forward contracts by very low investment, a fraction of amount, simply to protect the fair value of the inventory. We are not actually delivering the inventory to anyone. So it's based on assumption that what if we had to sell it, what if we had to deliver it at this price, what would have been the gain and what would have been the loss. It's on the assumption basis and settled on net. Net means what if you would have delivered, what is the gain, what is the loss on the forward contract. Any net position becomes an asset or liability for us to be recorded. On 1st July 6th, all the conditions of hedge accounting are met. Only when the conditions of hedge accounting are met, we can use hedge accounting. So at 31st December, that is the end of the reporting period. 31st December 2006, that is reporting period. And the fair value of inventory is actually 220. Fair value of inventory is $220. Total, this is $10,000, 200, rounding to 1,000. Total turns out to be 2,200. 10,000 into 220, rounded to 1,000. Futures price for delivery on the same date. Futures price for delivery on the same date or at end of reporting period, that if you have entered into this forward contract today, the futures price was $227. Futures price $227. Total 2270. The fair value of the inventory is 2200. It has sold for 2000. How much is the loss? It had expected the inventory to fall, but actually the fair value of the inventory has increased by 20. There is a gain in the fair value of inventory, which means there will be loss on the forward contract because there is a hedging relationship. How much is the gain on inventory? How much is the gain on inventory? From 2000 to 2200, how much is the total gain? And how much is the loss on the contract? You have entered into a contract to sell for 210. Total sales value is how much? Total sales value is how much? Sold for 210. 2100. But the futures price for the same is 2270. How much is loss? You have sold for 2100. But at the end of the reporting period, the same inventory, the futures price for the same is 2270. How much is the difference? 2270 minus 2100. Loss of 170. Change in fair value of inventory. It is 2200 minus, it was initially 2000. There is a gain of 200. What is the net position? If you have to settle it, you'll have to pay or you'll receive. If you have to settle this forward contract, the inventory change in fair value is 200. But in the futures market, the change in the forward contract is only 170. So you settle this position by 30, that will pay 30 and will settle this position. So what is the entry? What is the entry on 31st December? This loss of 170 is resulting in a financial liability. This gain in terms of inventory from 2000 to 2200 will result in increase in the value of inventory. Are you with me? If you settle it individually, then it is not hedge accounting. But if you take these figures in connection with each other, you plan to settle it against each other in future. So the difference in forward contract will be measured at what amount and what will it be considered? The loss of 170 will be charged to P&L account debit. It has resulted in a financial liability because you suffered a loss. Credit 170. If it was settled on this date, this would have been settled on 30. Inventory's value increases by the end of the period by 200. Since you are measuring this inventory at fair value, you are protecting the fair value of the inventory, is the reason you are remeasuring it at the end of each year. Profit or loss 200. On 30th June, on the date of settlement, the trader sold the inventory and closed out the futures position at spot price of 230. So value of inventory on 30th June 2007 sold for 230 means total value 10,000 into 230 rounded to 1000 equals to 230 2300, sorry, 2300. The last value was 2200. So gain in fair value of is equal to 2300 minus 2200, which was the position at the end of the reporting period, that is 100 gain. Futures position on the same date is also 2300. Futures market price on 31st December 2006 2270. Futures market price on 30th June 2007 2300. Difference 30 loss. Earlier we recorded a loss of 70 to financial liability 170. Now again there is a loss of 30 to financial liability. This entry will be cash account, debit 2300, credit inventories. They were recorded at 2200, but there is a gain of 100 on the sale now. Credit profit or loss account. For the futures market settlement, it is profit or loss debited for the loss on futures contract, that is 30. Financial liability credited by 30. The total balance in financial liability is 200. You settle it by making the payment. Settlement of futures contract. Financial liability debit. Make the cash payment and settle the net position. Credit 130 plus 170, 200. 200. This is how we deal with fair value hedge. Any concerns? Any questions? There is no comparison in terms of what will go to OCI and what will go to P&L. The entire difference of gain or loss will go to P&L, and a financial asset or liability will build up if there is a loss. Financial liability will build up if there is a gain. Financial asset will build up, and the hedged item, the change in fair value will record normally. On settlement, any gain or loss we are able to set off against each other. So if you notice, we have been successful in protecting the risk. If there was no hedge accounting, it would have been total benefit. The 2000 of inventory was sold for 2300. There would have been a total gain of 300 on inventories. But the entity was expecting a fall, which had resulted in a gain in inventory and a loss in futures contract. Gain in inventory and loss in futures contract has been resulting in minimizing the difference by 100. Now there is a loss of 200, but gain of 300. Minimizing the exposure to risk. This could have been reversed as well. So hedging means we do not intend to gain, we do not intend to lose, we plan to minimize the exposure of risk. This is all about fair value hedge and cash flow hedge. And with this, we come to the end of the chapter on financial instruments. If you have any queries, please ask.